Thank you very much. My name is Claude Lemasson. I'm President, COO of Guyana Goldfields. I've been with the company 3 years, moving the Aura project forward through pre-development phase, which we're currently completing and going to move to development and eventually production. I will also be making some forward-looking statement today. The Aura project, we just came out with our feasibility study about 9 days ago, a mine plan of around 4.4 million ounces of gold, and we continue to look at the results, and we're looking at some optimization work, which I'll talk a bit about today. The corporate snapshot, we've got 29 million in the bank currently. Our burn rate is about 3 million right now. We'll go down to about 2 million starting in April. And you can see that we're fairly widely held by some pretty well-known institutional funds as well, pretty good proportion of retail and some insider as well, myself and Pat Sheridan Jr. Analyst coverage, well covered by 12 different analysts. And obviously reports are available through them. And you can see a fairly wide-ranging list of targets, anywhere from the $7 to $18. CSR and sustainability, we are following international standards as a TSX-listed company. And we are working with the IFC of the World Bank. They've been a shareholder for over 6 years. Continue to be very supportive, and as this is a major project in Guyana, obviously they're very interested in seeing successful development of the asset in country. This is a supercontinent concept map bringing together the West African Shield and the Guyana Shield, and you can see that we listed some projects in West Africa. There was a lot of focus in the last 10 to 15 years in West Africa for development of large assets. And now we believe that investors are actually interested in some of the stability of South America and putting a lot of focus in the Guyana Shield particularly, which is widely untapped as a region. And we believe that we are located in the best jurisdiction in the Guyana Shield, which is the country of Guyana itself. So let's talk a little bit about the country. Guyana is the only English-speaking country in South America, operates under British common law, very similar actually in style to Canada and to the UK. Democratically elected government. There was an election in November. The incumbent party was re-elected with a new president, and the prime minister actually came back and got re-elected as well. It's a fairly small country, 750,000 people that are living in country, and pretty low GDP, although the GDP is growing slowly by $2.2 billion. Our project is going to increase the GDP by 25%. So we're a pretty major foreign investment. The country itself is pro-mining, pro-development, and very supportive. We've had excellent relationship. We've been in country for 16 years, so we pretty well know all the players. And there is a history of production in Guyana, but not so much from a large-scale perspective, a lot of small-scale and artisanal. The only large-scale gold mine that ever operated was the Omai gold mine, built by Cambior in the early 90s, operated roughly from 95 to 2005, and produced about 4 million ounces. So our asset, undeveloped, is already bigger than Omai ever was, and will continue to grow from there. We did sign a mineral agreement with the government in November, and also the government issued us the mining license. The mining license is essentially the license that you need to build and operate the mine. So we are fully permitted on this project, and we're ready to go. Part of the mineral agreement is a royalty of 5% if the price of gold is below $1,000, and it's 8% for above $1,000. So obviously in today's environment, we would be paying 8% royalty. There is no other royalty of any kind, and there's no ownership of the government into the project. So the project is 100% owned by the company, and the only obligation is the royalty and obviously corporate income tax of 30%. The government had actually lowered the corporate income tax by 5% last year, and then we negotiated on an increase on the royalty, and that's what we ended up with. So we're pretty confident this being a new, fresh agreement in Guyana, and this is the same type of agreement that's being applied to any other gold mining company that is looking at developing an asset in country. At least what it does is it sets the tone moving forward as far as what the expectations are, and then you're able to run your economics based on that in your models. So it's very clear, and it's a very clear policy, which I think is very good for companies, as many countries, as all you guys know, are revisiting their fiscal and royalty regimes and putting projects in jeopardy. Unfortunately, at least we know where we sit and we can move forward from there. So where are our properties? We're in the northwest part of the country. You can see Georgetown, the capital, on the Atlantic Ocean, and we're due west from there, about 170 kilometers away. We got two main sets of properties, what we call the Aurora properties in yellow and the Aranca properties in orange. So we have control of over 410,000 acres in total, fairly large set of concessions. The Aura project is part of the Aura properties, but at Aranca we actually have two discoveries there. One called Sulphur Rose that we announced in December 2010, and the second one we announced last week, just about 6 to 7 kilometers north of Sulphur Rose. And we started issuing some drill results on that and trenching results. But I'm going to talk about the core asset, the Aura Gold project itself. So we issued the positive feasibility study, and we issued the results. We have drilled this area since 2004, and so for about 7 years in total. We've drilled over 365 kilometers of core drilling through this. All the mineralization is contained within what we call the Golden Square Mile. So this is some of the feasibility study results. The highlights: it was priced at the 3-year trailing average of $1,300 gold and at a fuel price of $100. And then it's a combination open pit underground mine. So we start with the open pit, then we bring in the underground. After that, 22 years in total, 9 years in the open pit, 17 in the underground, 8,000 ton per day production through the mill. We're only producing gold here. There's no copper, no silver involved. Pretty straightforward metallurgy. 95% recovery. The mine plan, 4.36 million ounces currently. Average gold production, if you look at the first 10 years specifically, you're over 250,000 ounces a year of production. Cash costs, $522 without the royalties, $626 at that price with the royalty, so still a very competitive cash cost. The initial CapEx, $525 million, so about $500 million to build the mine and start operating out of the pit and get cash flow. All the other CapEx would get funded, including the underground CapEx, from cash flow over time. You can see the pre-tax IRR at 14.9, and that's obviously at that price of gold and that price of fuel. The payback, 7 years. So these were the results we came out with. Reserves came out as expected, 4.6 million ounces from a 5.7 million ounce resource, M&I resource originally. And you can see we've got inferred on top of that. So overall, all resources included, we've got over 7 million ounces, and we're continuing to drill. So that's actually growing right now. So this gives you a good idea of where the open pits. It's a series of open pits, about 6 of them combined in light blue. The other colors are all the mineralization in the different areas, and you can see a big part of the deposit is right in the forefront there at Rory's Knoll in dark blue, with a portion of it in the pit, and then the rest extends underground. So what does that look like? When you look underground, it looks like this. The pit's at the top. You can see the blue, line in blue is the shaft that we would build. then the drifts across the main ramp up and down along the edge of the ore body, and then obviously mining. We're doing long hole sublevel open stoping into the deposit. Now what you see in there is the current resource all the way at the bottom. First of all, the mine plan is at 1,320 meters, so 1.3 kilometers deep. The resource extends, as far as M&I, to 1,560 meters deep. And the pipe itself, we've got drill holes through it below 2 kilometers. So we continue to expand this pipe. So this will be definitely over the longer term a very important deep underground mine, similar to what you find in Quebec and Ontario, actually. I mentioned the process, the metallurgy, very quickly. Simple, conventional gold milling, SAG mill, ball mill combination on the front end, followed by gravity. Up to 30% of the gold is through gravity. And then we go into a carbon and leach CIL circuit, cyanidation, and we recover 94.8% of the gold. There's a little bit of optimization to do there, and we believe the recovery will go even a little bit higher with a little bit more test work to be done. So the timeline, where basically the number one star is, we have been working on off-site infrastructure. We are starting to work on on-site infrastructure. We've got some key facilities like a river dike, tailings, processing plant, all to be built in the next 2 to 2.5 years roughly. We get to open pit production and start pouring first gold in late 2014, commercial production around that time, and then we carry on. So from that point on, we get cash flow, and after that, in the dark blue, is the development of the underground, which takes about 4 years because it's pretty massive. So it starts after, in 2015, is supported by the cash flow and gets developed, and you get into commercial production underground in 2019. And then it extends overall in total 22-year mine life currently. So this is just an idea of the profile. So the production itself in the mill is the blue line. The cash cost is the black line itself. And then where does the feed come from as it's being mined is the yellow and brown line, yellow being the open pit, brown being the underground feed. So you can see how it's an open pit, and then the underground kicks in and takes it for much longer term. One thing we did with the analysis is obviously we're obligated to report in a certain way because of 43-101, so we report $1,300 gold and $100 barrel for crude oil. We don't believe that equation that makes any sense and should never be reported that way, but that's the way it's got to be done. What we do believe is there's actually a correlation between the price of oil and the price of gold, and if you look at the 3-year trailing average for both, it's 16-1, and it's bang on. So if you look at the middle column, the base case being on the far right, the middle column being 1775, where we were about a week ago. Look at the price of crude oil, 109. That should have been kind of the real price to compare to at the time, at this price of gold. Then you can see the numbers, what they look like. So spot price with 109 oil, you're looking at $1.2 billion project in value, 23.6% IRR. So those are pretty solid numbers. And you can see, obviously, if gold goes up, we push the price of gold up, but we also push the price of oil with it to compare. And we believe that if gold is at 2,250 in a few months, where it probably will be, price of oil will be there somewhere too. And if you look back and when we were at $1,300 gold, the price of oil was actually down in the $80 range. So this makes a lot of sense, and certainly when we look at the economics internally, and that's a fairly important concept. This is just a quick site plan that's in the feasibility study. You can see the pits at the top, other key facilities, process area, mine waste stockpile, fairly compact site overall, and there's nothing, no neighboring communities, nothing nearby, and we're really in the middle of the jungle along the Guyana River. Logistics and infrastructure, an important component. You can see Georgetown on the far right, then nearby the Buckall Port. So we're developing that asset. It's already quite advanced, and then there's an existing road going all the way due west towards our projects, connects to our properties at Aranca for exploration, but then we cross the river, or what we call the pier, and then we end up at the Aura site by road. So most of the movement of material and people and equipment will be down this road. Like I said earlier, it's about a 170-kilometer road from Buckall to the site itself. So it's very manageable. It's infrastructure that you have to look at developing, but it's very manageable once it's in place. Optimization study that I talked about. So now that we've completed the feasibility study, you automatically identify some opportunities, and we are currently chasing some of those opportunities in the next 3 to 4 months. Open pit, there's a little bit of optimization to go back and do there with some different parameters. We're going to look at contract mining. Now that we've got a full feasibility study, we can actually go to contractor and say, okay, what would you do this with? When we talk about contract mining, we're talking about South American type contractors like in Brazil or Peru or even Mexico. Underground, same thing. Exactly when the timing of the underground, when should it start, when should it end, and we're going to look at the underground design and optimization. We've done a lot of that work, but we want to revisit a couple of things there. Used equipment. Now that we have completed our feasibility study, all the equipment in the feasibility study is brand new. But some of the deliveries are a bit long, so you want to look at what's available in the market. Now that we have a feasibility study in hand, we're able to start shopping around for equipment. We're going to be doing that. The process plant was actually originally designed in our feasibility study to 9,500 ton per day because we had the underground starting a bit earlier. Midway through the feasibility study, we decided to delay the underground a little bit. But the design, it was too late to change the design. So we're carrying about 10% extra cost, which is about $16-17 million in our CapEx currently that shouldn't even be there at all. So we're obviously going to go back, redesign that 8,000 ton per day and claim that. We're going to be doing we're doing more drilling. We're going to continue drilling and issue a resource towards the year end, an updated resource on the project. And alternative power is fairly important. That's something we've been pursuing. About 30% of our cost is currently a heavy fuel oil, and so it's related to power, and you got to truck all that in down the road to your site and operate 18 megawatt kind of power requirement. So we are looking at a hydro project combined with a biomass power generation project. Major opportunity, especially with a 22-year mine life, to save a lot of money on our cash costs down the road. So we're pursuing that. We're going to have results of that by year end. It doesn't stop the project from proceeding. We'll start with HFO, but this project, if it's being developed for hydro biomass, would kick in kind of at year 3 of production, and then would be for the rest of the mine life, and potential for significant savings in the future. So definitely pursuing that. Just a quick word on exploration. We are continuing to explore. I didn't mention we had a new discovery announced last week called N1, so we're pursuing that some more near Sulphur Rose, where we already have a resource on it. You can see it's not a big resource, but it's growing. It's 560,000 ounces in total. And Moinamu is another good prospect that we have. So we are an exploration company and continuing on that track and looking at multiple discoveries, ultimately with Aura being the kind of the anchor project. And this is part of N1, just to show you and where this is the Sulphur Rose. I don't know if you can see my little pointer there. This is Sulphur Rose, and this is about 7 kilometers. This is the new discovery here. So we're seeing a complex developed near Sulphur Rose of multiple deposits that potentially could become its own mine. So this is very interesting to us as well. So to wrap up, critical advancement of the Aurora project. We're moving forward. We're fully permitted, and we've got a feasibility study. We've got a bit of optimization to do. We'll have to raise money, obviously, for the project itself to build it. Meanwhile, we're continuing on the exploration at both Aurora and Aranca, and we're looking at doing resource updates and issuing more drill results as things go by. So we've got quite a few milestones in the next few months that are going to happen, and they have been happening, and we're continuing to do that. Leave you with this slide. This is, instead of looking at P over NAV or dollars or cost, we look at real things called resource and grade. And you can see where we're located at the top if you combine the open pit and the underground. If you look at the open pit only, it's the circle in yellow. You can see how we're different than many others, meaning with a much higher grade deposit. Our pits is 3 grams average. That's pretty high grade pits, and we're starting to be sizable in the, depending which one you look at, but in the 5 million plus ounces range. So. And there's potential for that growth as we move forward, but our grades are up there. Okay,
thank you very much, Claude. So the question everybody obviously has is, it's large and it's high grade. Why are the NPV and IRR so low, particularly after tax? And of the optimization things that you're talking about, which ones have the greatest likelihood in the near term, next quarter, to shake this up in the marketplace and to get people to understand that those numbers aren't where it's going to be?
Fair enough. And yeah, we believe that what we issued last week was extremely conservative, and certainly that's been reflected in our stock price, which makes it a buying opportunity, obviously. But the high grade is really in the pit. The underground is not considered a high grade. It's 3 grams and a bit underground. So there's real opportunities to revisit mining method underground and potentially either improve the grade or improve the cost underground. And that's a big portion of the deposit. The pit itself, if we were to, and I can't give you numbers because it's not public, but if you look at the pit portion itself, 9-year mine life at 3 grams, it's a highly profitable mine, except you have to think long-term and longer than 9 years, because there's 2/3 of the ounces are underground, so you have to look at that. So it depends how you look at it, but certainly with the optimization, the items that we've identified, we didn't just say we're going to revisit everything in the feasibility study and re-optimize everything. It's not the case at all. What we did is, as we were completing the feasibility study, we identify these items that are absolutely very clear, and it's probably only, we're leaving, I'm going to say, 80% of the feasibility study alone doesn't change. We're just zeroing on 20% of it, and then within that, we're revisiting some very specific items where we think we're going to have gains. So I think at the end of the day, the list that I gave you there, every one of those line items will have a benefit, will have an improvement on either CapEx, OpEx, or combination of both, which ultimately will all be combined and will result in an improvement on the NPV and the IRR. And that's that optimization. The bulk of that work is in the next 3 to 5 months. So we will come back to the market with results around that time. The only one that's going to take longer than that is the alternative energy one, which takes about 6 to 8 more months to bring that together. That's a bit of a separate project because it's longer term. It's also a very key part of the project, but it also needs to be treated a bit separately because it needs to be permitted as a hydro biomass facility separately, which the government is very supportive of. We just have to get to it and get to feasibility study level to do that. So that's a great opportunity. That's a little bit longer term, or let's call it short to medium term. In the short term, optimization study next 3 to 5 months, which I think will come back and with some numbers that are definitely improved, and we're actually pretty excited about the opportunity that's going to show moving forward.
Yeah, you can't reissue the study each time you change something. So, what can you do in the press releases to make it clear to the market the impact that the optimizations may have on the?
Yeah, I think what we need to do is to state what the changes are. For example, if we redesign the mill, it's 8,000 ton per day, we go through the redesign process, it's QP'd again, and we say the difference between the original stated number in the feasibility study and the new number is, for example, 16 or 17 million, whatever it is. So we're able to state the improvements and the differences.
You will be able to say that each step?
Sure.
Okay.
As a combined package, yes.
Right. Marion?
When you mentioned Cambier's project, are you starting with a saprolite pit?
So we do have saprolite, except it's a fairly small portion of the deposit, and you have saprolite in every one of the 6 pits. So you don't really concentrate on one pit specifically. We have a much less saprolite than Cambior had or than Rosabelle has in Suriname. So in total, the resource is about 6%. In the pits, in the open pit only, it's about 12%. So fairly low number. So we do start mining the saprolite first, but very quickly we're into a hard rock, and then we blend the two.
Do you think the heavy rain season will impact your plans to?
We do look at the rainy season. We know that there's 2.5 meters of rain per year. So we've designed the whole project in and around water management. So once you build roads, you build them with proper diversion of waters for rainfall and those kind of things. You actually have to build your road, to standards that will sustain the rainfall. Once you build those roads, then you can operate 24/7. Rainy or not. What typically happens in these operations is the drivers, for example, of the haul trucks, if it's downpouring, which is typically the way it works, downpouring for 15 minutes or half an hour, they will actually stop, park, wait for the rainfall to happen, things to drain, and they go again. So they're stopped in very small increments, and we allow for those inefficiencies within our plan.
Okay, thank you very much.
Okay, thank you.